In today's video, we're going to go through the unicorn model. I have been learning about this model through Ash Trades. You can look him up on YouTube as well as Twitter. He's got a pretty good series on it, playlist on it, and he just started documenting it on YouTube. Someone good to learn from. But I'll run through my my simplified version of it. So here it is, right out front. We're going to go daily bias, so I'll just run you through it here. Here's an example. So daily bias, real simple. You got internal range liquidity and external range liquidity. Your external range liquidities are your swing highs and swing lows. Internal range, for simplistic version, is just fair value gaps. But it could be a range of things. So in this case, we can see the day we're trading in, price is pulled up and rejected back out of this daily fair value gap. You can see up here, we pulled into a fair value gap and it respected it. So we can see bearish has been what's been being respected. So here we are pulling up into one again. We could expect price to come down to this external range, or at the very least this daily volume imbalance. So our daily bias is bearish. So then number 2, higher time frame liquidity grab. That is the 1 hour for me because we're trading on the 5 minute. Sorry, you can do the 1 hour or the 15 minute depending on what you want to do. This trade was on the 15. So we can see right here, we had a swing high. We draw it over. There is our liquidity grab, the raid on liquidity. You know, people saw this big bearish bar. They got in short, placed their stops above here. What happened? They ran it back up. And then this is a rejection bar even. It finished down below it. I like to enter on the 5 minute, but you can take this down to the 1 minute. It's fractal. It works on all time frames. You just need the right time frames paired with each other for the higher time frame and lower time frame stuff. Here, let me add this. Bring this down to the 5 minutes so we can see it. So lower time frame, here we are. It grabbed it. This is the high it grabbed it from. So now we're looking for displacement through the breaker. Well, where is the breaker? Well, we took this high, so we are going to need it to displace down through here. So our lowest down close candle, since we are bearish, it's going to be a down close candle, which are the black candles here. Which one's the lowest out of all these candles here that led up to the liquidity grab? You know, here's our high, so between here and here, where is our lowest down close candle? Well, it's not this one, it's this guy. This guy's the furthest down. So this is our bearish breaker. Technically, it's this whole series, but for this example, I like to just trade with the lowest one. So we will grab here to here, and it's the whole candle. So we're going to need price to do what? Displace through the breaker. So we need it to strongly push through that. So let's see what happens. There it is. And we need it to close below it. So it closed below the breaker. We have strong displacement. Now we need a fair value gap, any fair value gap, to be inside of that breaker block. Do we have that? Yes. Right here we have a fair value gap. That's all we care about. It does not have to trade back up into it. It's nice if it does, but it doesn't have to. So the fair value gap is inside the breaker block. Where's our entry? It's at the beginning of the breaker. In this case, it's a short, so we're going to place our entry at that low of the breaker. Where's our stops go? At the other side of the breaker, somewhere above it. You could go all the way up here. That's a little too much for me. We'll just go just a little bit above, a tick or two. And then our TP is a plus 2R. So we're just going to look for a 2 to 1. There it is. And we will see if price nicks back up. There's price coming back up. And there is your profit. So that's how to trade the unicorn model. That's how you find the breaker block. That was the hardest part for me, is how do you find this? Because I've been trading this without knowing it for some time. But what I was struggling with was finding the breaker block. And to simplify it, the way that I've done it in my mind is I find our points of where liquidity was grabbed. I connect those 2 points like I just did here. And then I find, okay, I'm bearish. Where's my lowest down close candle between those 2 lines? So that's pretty simple. It's this guy. Boom. Done. Then you just wait. Do we get displacement? Yep. Is there a fair value gap? Yep. All right. Enter here. Stop there. Plus 2R. If you are more advanced, you could do things such as standard deviation. You know, we can take this to here. And this being the NQ, I'd expect a 2 to 2.5. So I'd be looking at these equal lows. I bet price reaches down here. We'll see. But there it is, right at 930. You know, never would have been stopped. But that's a more advanced tactic. This is just supposed to be a simplified version, but that's the next step, is how you take these. That's the trade I took Friday. I used the standard deviation to get, I don't even know what I walked away, 60 or 70 points. So you can get some good runners with this kind of setup. You just have to leave that stop where it's at. In my opinion, that's how I like to trade it. But that's all there is to it. There's no moving your stop in this system or this model. You just got to remember to have a fair value gap with strong displacement, and that's it. See you all next time.